Alright, so let's begin. The way one person uses their bike or car may vary vastly from another. It is influenced by your overall lifestyle, what you do or you don't do, and a few other factors. Some may not drive their vehicle as frequently as commonly assumed, and some may utilize it above and beyond the average expectations. And this is where a pay-as-you-drive insurance policy comes into the picture. What exactly is this kind of a cover under your motor insurance policy? Let's understand all of this with Kevin Menezes, Executive Director, PolicyBoss.com. Kevin, good evening and welcome to the show. Clearly, we're going to talk about pay-as-you-drive add-on or a cover that you can buy under your motor insurance policy. But then let's understand the tech specs. How exactly is this kind of a cover designed?
Yeah, thanks, Kavita, for having me on the show. So this is an exciting new product. So let me explain it. So pay-as-you-drive is part of UBI, which is usage-based insurance. So that can be bucketed into broadly two categories: pay-as-you-drive and PHYD. PHYD is pay how you drive. The main idea is that instead of a fixed price, drivers have to pay a premium based on distance traveled, driving behavior, etc. Now let me explain to you how this pay-as-you-drive insurance works. In pay-as-you-drive, premium is calculated basis distance traveled as a primary factor. So lower the distance, the higher the discount on the premium. While in PHYD, which is pay how you drive, the insurer factors, consumer behavior like speed, location, drive, braking, etc. So such policies have been prevalent in the West as such, but now it's gaining momentum in India. So let me explain to you, from the Indian context, there are many insurers offering you pay-as-you-drive. So let's assume, so the premium basically depends on the kilometers insured drives. Okay. So currently, the problem is the comprehensive car insurance policy for a customer who drives, say, 50,000 kilometers will be the same if he has done, say, 10,000 kilometers. Now, this is because the usage does not matter. But with PAYD, okay, the usage does matter. Okay. So while purchasing the plan, you'll have to choose the options on the distance to be traveled, and basis that you'll get a discount on your premium.
So, Kevin, I want to understand over here is, so this is first of all not a comprehensive cover, is it right? It's not like a standalone policy. It is a cover that you can add to your existing base cover. Is that right?
That's right. This is an add-on cover.
Right.
So you have to add it to your base cover.
All right. So one is the premium that you're already paying for your base cover, for your comprehensive policy. And then on that, to get a discount on that particular premium, you can buy this as a cover, right?
That's right.
Okay. So you said that you can when you're buying this particular add-on cover, you can decide the kilometers according to which your discount will be calculated or analyzed. So when we're talking about deciding the kilometers or the distance traveled, how will that be measured? If I give a rough figure, and what if the figure is maybe below or above that? Is there any mechanism to from the insurance companies, which will which will come into addition while buying this particular add-on cover?
Yeah, so that's a good question. So basically, when you're buying this cover, okay, the insurer gives you like slabs basis distance, like up to 3,000 per year, 3 to 5,000 per year, 5 to 10,000 per year. So these are the slabs. So the minute you choose a particular slab, the discount you will get on your own damage portion of the premium. So that part of the premium gets reduced. So just to give you an example, when you buy a car insurance, it has two parts to it. It has the own damage, which covers the damage to the car, and it has the third-party liability portion, which is fixed. So this cover, you get a discount on the own damage portion of the car. So so the question what you've asked is, what if a person drives more than the necessary kilometers? Okay, so over there, the insurer also gives you an option to kind of top up the kilometers. So that option is kind of available for the insurer. So you can top up the kilometers. and that's how he can opt for the plan accordingly.
Kevin, are there also different type of components to this particular add-on cover, like a third-party component and your own component?
No, I'm saying the plan is two parts. Third party is a fixed pricing. The pricing is fixed. It's a liability cover. The add-on cover and the comprehensive cover is a comprehensive cover. Now, in PAYD, the lesser you drive, you get a discount on the comprehensive cover. Okay, so I'm saying now, I'll just give, to make it simple, I'll just give you a simple example. Now, let's take the premium of a car is 10,000 rupees. Okay, say the liability premium will be say around 4,000 rupees. Okay, the comprehensive premium will be on the own damage will be say around 3,000. And there is also other add-ons like the nil depreciation, the return to invoice would be another 3,000. So when you opt for a PAYD plan, you get a discount on the own damage without the additional add-on. So it's like an add-on cover where you get a discount on. So let's take if you get a discount of say 20%, so it works out to say 20% of 3,000, which is the own damage part. So the discount on a 10,000 premium would probably work out to around 600 rupees.
All right. Also, can you also tell us who exactly should be taking this kind of an add-on cover? Because not necessarily everyone will be benefited by taking this kind of a cover. So the ideal customers would be?
Yeah, I see. So the ideal customer, the customer who drives less. So let's look at who are the kind of people. So you still have people who are work from home. Okay, post pandemic, you still have a segment of people who work from home. Okay, so they kind of probably use a personal cars over the weekend. You have people who use the official transport. You have people who use public transport. You have the retired, the older people who kind of drive very less. They drive for very specific tasks. And of course, you have a large amount of people who have multiple cars. So they may probably be using their second or third car far less. So they can opt for this kind of a plan for that kind of vehicle, for those vehicles.
Kevin, also now almost all kind of general insurance companies have come up with this particular add-on cover. How do you differentiate it? I mean, are the features standardized? Is there uniformity in the offering, or one gets to choose or decide as per the discount that they are getting and other additional features?
So as of now, the core product is basically mileage. So everyone has their slabs where they give the discount on. But there are some additional features. There was one company which had a switch on, switch off kind of a product. So let's assume like you're traveling abroad for a month. You just kind of switch off your insurance. So you kind of save some money over there. Then there are some companies who have variations like, in case, at the event of claim, let's assume you've kind of driven more than the necessary kilometers as per the plan. So they tell you to pay some kind of a goodwill premium, an extra amount of money. So there are these kind of variants, but the core plan revolves around the kilometers, the distance you drive.
Kevin, also now talking about these kind of an add-on cover, and you clearly explained as to who will be an ideal buyer for this kind of a cover. But then let's also move on to the other aspect of motor insurance. Anything new from IRDAI in terms of guidelines or in terms of uniformity that's now being implemented as per the motor insurance policy?
So the regulator IRDA has been quite aggressive. They've been pushing the insurers to come up with various kind of innovation and come up with this kind of plan. So as you know, PAYD is quite widely prevalent in the West. So taking a clue from them, there are I think 7 or 8 companies who've launched their products. And what IRDA has done is that they've kind of simplified things. So what happens now is that an insurer under the file and use guidelines can come up with a product pretty fast. Okay. So earlier the necessary approvals were taking far long time. So now you can come up very fast as long as they have the board approval and they have the certification from the actuary. So it's pretty fast and quick. And I think maybe in a year's time you'll probably find 70 to 80% of the companies offering this product in the market.
All right, I think that will be all. Thank you so much, Kevin, for removing time and helping our viewers with this.
Yeah, thank you. Pleasure.
And we move on.